Very recently, a new analyst firm has started coverage on ZEPP Health. I posted this screenshot on Twitter. By the way, go and follow me there with _MM85 for updates. And they here have a price target, a fair value of around $5 given how they analyze the company and what they're seeing. And you can get the full report if you go into my Patreon community, become a member there, and then this helps to support the channel. You get the full ZEPP Health interview, which is 1 hour and 20 minutes, uncut as of today already, plus the analyst report, a couple of PDF pages going through this analysis, and possibly I'll also do a video on that, Patreon only, on top of that. But now have fun with the next part of my interview with Leon Dong, which is going more into depth of the Q3 numbers and a couple of questions with that. And as well, please make sure to give this video a like, and now we can jump in.
So that's why we also mentioned that we were in a transformation phase before for the past 6 quarters. Now it's only the start, or we even see it's at the end, the light at the end of the tunnel for a transformation journey. And obviously, if you put an analogy to this, I think we're running a marathon where we only did the warm-up part of that marathon, right? Now, so let's just rewind a little bit on where this company is coming from. Right, this company got listed in 2018, and then by that time, majority of the revenue is from Xiaomi, right? So I think I have told the story many times. There are two extremes. One is to be like a Foxconn-alike type of company, whereby you only do ODM, OEM for big brands, for Xiaomi and Apple, etc., etc. The other extreme is that you have your own brand and you want to be positioned as a company which is generating and profitable back on your own brand revenue, right? So obviously, the transformation we're going through is to change from ODM, OEM supplier to Xiaomi, let's put it in a very extreme way, into self-branded company which has Amazfit as majority of the revenue source, and that through that revenue source we can have a profitable margin and profitability out of that own brand. Our majority of the revenue is coming out of our own brands, right? So that you can call yourself self-reliant, right? I think we hit the first milestone whereby we think we are self-reliant, and mind you, I'm not saying that we're going to ditch the whole of the Xiaomi sales. Definitely not, right? So Xiaomi still holds 20% of our shareholdings, and we remain as one of the biggest company in the Xiaomi ecosystems. But we also realize that year over year, because if you look at Xiaomi's the Mi Band profitability year over year is in decline, and also the category is in decline as well, because more and more people they realize that a smart entry-level smartwatch can do the same as the band, and is actually priced at a similar level. So you have a bigger screen, you have a better connection with your phone and everything. Then why go for a band? I'm not saying that the band as a form factor is losing its attraction, but I'm just saying that if you have a product which has entered a mature stage, and it has been going on, because we did the band product, I think this is already the 7th or the 8th generation of the band, right? Then it's and every year it just screen gets a little bit better, and then probably the UI is getting a little bit faster, but you don't really have any of the new functionalities like what it was before, which excites the consumers. right? So that's why we see the urgency of such a change, and also Xiaomi has indicated their product or their hardware, they do a cost plus 5%, right? So every year you see the margin of the Xiaomi product is getting squeezed, and also the revenue was in decline. So that triggers us to think about the transformation that we should, as a first step, to focus on the profitability rather than on the scale. That triggers us to tactically think about how to phase out those revenues which does not even generate a return. So take Q3 as an example. Our revenue in absolute amount went down by 50% versus last year, but on the gross profit we're making in absolute value is the same. So it means that half of the revenue which we lost from Xiaomi, it doesn't make any money. It was just a painful fact per se. Now, so and if you continue to do so, every year your margin gets squeezed further, then this company is going towards the end. So that's why we made this choice of transformed from an OEM and ODM player to a company which is first self-reliant on the self-branded products. And then we probably, as a second step, will look at how to expand the growth again. Right? So that's why I'm saying in the past 6 or 7 quarters, what we're doing is in essence to change the business model from ODM supplier to a majority of the revenue is self-branded products, right? And then if we start or having that business model worked out as a second step, if you are looking 2 quarters out or so in next year and the year afterwards, we should be back into our track on profitable growth, whereby we need to increase our revenue, we need to increase our profitability. Now, but then, yeah, you don't build Rome overnight. It has to go through different phases, and for such a big company to turn its direction, it's painful. So that's why we spent the past 6 quarters in doing so, and I think we are delighted to see that our strategy start to yield early success right now. And then I also mentioned in Monday's call that we see that our operating income should be profitable also in Q4, right? So it's already the 3rd quarter whereby we do quarter-over-quarter improvement on gross margin, we do quarter-over-quarter improvement on profit, and I think all the KPIs I'm watching at this moment is trending to a nice trend towards the future. So that's why I'm actually positively optimistic about the company's transformation, about our future, and how can we gain more shares in the wearables domain. Right?
Let's dive a little bit deeper here, because like how much, of course, I mean, the main bulk of this profitability is coming from cost cuts, as we've discussed, but it sounds like what you're guiding towards or seeing there in terms of that also revenue growth at some point will pick up again, and that we see better margins and better ASPs. How much has that to do also with the latest product mix? Maybe you can explain a little bit to those who haven't watched this transition in full, like what are the new products? I think, by the way, you also mentioned, I think there might be 2 more products coming later this year. So maybe, help us understand where is this company currently in this transition on the product side, and how much of the future growth and profitability theme will actually be driven from the products themselves rather than, the operational efficiency.
Okay. Now, so I think first I have to correct you a little bit. I don't necessarily agree with you in full on Q3 profitability is coming out of cost cuts. Right? Okay. So I think it's coming out of 2 things. Number one, our gross margin actually hits 35%. And versus the trend of 20% in the past 8 quarters, or even sub 20% in the past, right? So basically, if you compare this quarter's gross margin, is actually almost doubled versus the trend on the average of the past 8 or 10 quarters, and is actually the highest in the company's history.
Yeah.
Right. So I think the Q3 profitability is a combination of higher gross margin coupled with good operational cost saving, right? And that then you do the math, it's at the moment is going to turn profitable, right? So I think that is the first thing which I want to correct you, because the gross margin improvement is the cornerstone of the whole story.
Mm-hmm.
And yes, the gross margin improvement is driven, and you probably, if you see and we have in our IR deck, the gross margin trend for the past 8 quarters for self-branded products as well as the Xiaomi branded product. You see that we have managed to increase our self-branded product gross margin on even higher than the 35%, which we reported in Q3. I think in Q3, it was around 40%-ish, right? And how did we do that? Because in the new products, we changed the products mix, we changed the retail channel mix, so that the new products which we launched in the market carries a much better gross margin than the previous ranges which we sold. Yeah, and that to some extent drives the value down a little bit. I think it's if you look at year to date, self-branded product sales is around less than 20% decline versus last year, but our gross margin improved and doubled, right? So if you do the math, then the money you get out of the same portfolio you're doing should almost doubled, right? So I think that's one of the key which drives the profitability of Q3, and that's why it gives us the confidence in Q4 we're going to yield more or less similar results. So I think the company's gross margin portfolio has been changed from traditional OEM, ODM players of 20-ish% to a structural above 30% or between 30 to 40% in the future.
Do you think
so
there is still some room to the upside as well? Like, let's say a couple of quarters down the line?
I think that for sure is, because as you mentioned, we do have new products launch on the way as we planned. And then with regard to what, excuse me, I couldn't say too much about it right now, but it can cover products which has a different shape or form than the smartwatch itself, because we also we're a wearable company, smart wearable company. So we will look at different type of wearable shape and form, as long as it can increase the value to the user, right? But it will have a close link towards the smartwatch, because especially if you look at how the industry is evolving, for example, together with the launch of the Apple Vision Pro, you see that the wearable of the watch gradually are becoming more and more widely accepted that the smartwatch would be one of the key components to our operating system if you want to use VR and AR, right? And obviously, Apple will have its own Apple Watch, but I think at certain moment in time, all the smartwatch will be used as something equivalent to your mouse, which you're using your computer right now, right? And all the gestures and all the wearable part of the things which we're doing could be in the future complement to that ecosystem, right? So I think now to summarize a little bit, number one step is how to change ourselves from an ODM and OEM supplier towards a self-reliant company. And I think we are almost done with that process, given in Q3 and Q4, the margin portfolio and the cost cuts which we're doing gives a positive net income number, right? So I think that's the first step we're doing. And obviously looking into 2024, together with the new product launches and the new form factors of the products, et cetera, we should be able to also start to grow again. Yeah, because I also agree with you, you cannot shrink to the bones, then you lost the whole relevance in the investor community. Now, we're totally aware of that. Right? But then for a transformation journey, it's not as simple as you want to do this, this, and this all together, and then you can do all these things at the same place. You need to prioritize, right? So that's why we did change or we did choose the strategy to do it in phases. Number one is to coming back to profitability as we're doing today. Number two is to coming back to profitable growth starting from 2024. Then I think the flying wheel can just go by itself.
All right. Before I talk a bit more about also the future prospects and other initiatives connected to that, maybe a couple more questions on the finances. So one important part that you've also done is you've serviced some of the company's debt in this quarter, right? So you're using some of the company's cash position, which from my judgment seems quite healthy. But of course, we also have to say it's still a little bit declining currently, despite return to profitability. But you've used some of that cash to pay off the debt, and then another part for share buybacks, which is also one of the frequent questions of investors, the retail investors, especially from ZEPP Health. You've now announced as well that you continue with the share buybacks, but I think the question usually is that we're getting why are, given the valuation of the company and the low stock price and I think almost 90% decline in the company's stock. So why don't we see larger buybacks on the stock side? And maybe give us a little bit of an understanding from your CFO perspective on how do you align the cash between making new investments, servicing debt, and share buybacks. What's here the trade-off in your views? Maybe also given, for example, the overall macroeconomics when it comes to what's the cost of debt, for example, in China. So what's your vision on these financial metrics here?
Okay, now, so good question, Marcel. Now, so let's look at the cash balance first, right? I think if you look back 10, 11 quarters or so, our cash and cash equivalent balance has always hovered around 1 billion RMB, right? 1 billion RMB, I think is equivalent to 170, 180 million euros or dollars, whatever however you look at it, right? Ballpark. Now, so I think we have kept that threshold very stable, even if in a in a profit losing quarters. I mean, as I mentioned, we did report 6 quarters of lost in the past 6 quarters. And I think from an operating cash flow perspective, which I kept on telling everybody that P&L is just a result, it's an impression. Cash is a king, right? So operating cash and positive operating cash has been always one of the KPIs I monitored in my day-to-day work. So despite 6 quarters of loss making, actually we are profitable or we're cash positive in 5 out of the 6 quarters, which you saw, right? And not to mention Q3, whereby the P&L is positive, right? So the company never had a cash burn issue, to answer your question. So we always kept 1 billion RMB equivalent cash on the side in order to fund our long-term growth, right? So that's one of the statement I have to make, and I have to convey this to the investor world. And on the share buyback, because the board authorized us 20 million share buyback in the past, and for 1 year and a half, we did bought back around 12. We still have 8 million to go, right? So the idea is we'll definitely evaluate the size of the share buyback. And as you know, if we finish this share buyback, we can actually start with, depends on the need, we can see whether or not we start a bigger share buyback program. Okay? But then I think that obviously couples with the operational performance and everything, how we look at the macroeconomics, et cetera. And we do see some recovery on the consumer electronics cycle, but still, as I mentioned on Monday's call, probably it has not been coming to the end yet. So to me, I just have to be more prudent on how we look at the future and how the macroeconomy is going to develop to decide on how we can best deploy our cash, right? So and then to on the China debt perspective, I think at this moment most of the debt it varies, depends on the duration. Most of the debt on average, I think it's around 3 to 4% on the cost to service those debt, and it's actually very easy for us to get cheap fundings in China. So number one, I don't need the debt. Number two, the cost to service debt is relatively cheap in China, right? But on the other hand, if you look at our market cap as per yesterday or today's calculation, is really miserable, right? My whole asset base is talking about $400 million equivalent, and my cash balance is talking about 170, and the market cap is 80. So there's definitely some disconnect between those, right? So I think we will try, and obviously the fundamentals has to improve. So I think we're in a good trajectory on that, and depends on that, we'll see how we can deploy the cash, and then and what do we do, right? So I think that's in a nutshell how we look at this. And number one, we definitely want to keep the cash in order to weather the economic downturn, right? If that ever comes, right? And then number two, we're generating positive cash flow on a quarterly basis, not by a small amount, by a big amount. I think every quarter we're generating more than 50 million RMB type of free cash flow, operating free cash flow, right? Because we do a lot of work also on working capital management. We also looking at the inventory management, et cetera, right? So cash is not a problem for us. So that's why, but we want to solve the disconnect between our current market cap versus the cash and asset we have. So we thought that, okay, if we retire some of the debt, but it's only a hypothesis, right? Then our valuation would come back by a bit, right? But yeah, so it's, as I said, I mean, we have a good thinking on how we deploy the cash, and we'll put the cash to work in the places whereby it can yield the best return on investments. And that's how we look at it for the time being.
Yeah, I think maybe with the coming quarters, like if they are going into similar trajectory, we'll see whether or not, ZEPP Health, the stock was just in a basket with many other small caps that are, investors were fearing that this company could potentially go out of business in a severe recession. And as you just laid out, financially, that doesn't seem to be the case at all for ZEPP Health. But maybe that was one of the overhangs. Who knows? We'll find out. The second overhang that I get asked from time to time, and personally, I think it's behind us, but maybe you can also quickly comment on that one, is regarding delisting, right? So there has been, I think, a very long period in time where I think especially smaller caps that perhaps have not the abilities to do a secondary listing at Hong Kong, may have to, take the company private or delist at some point in time, given the Holding Foreign Companies Accountable Act for US listed companies. So maybe in just a sentence or a quick feedback, what's your take on that matter?
No, I think the delisting thing is very much behind us.